Hello, everyone, and welcome to the FinDev Gateway webinar, Innovative Consumer Financing for Cooking Energy Access. My name is Abby Augusta. I'm an editor for FinDev Gateway, and I'm pleased to welcome you to this webinar. Our series of Gateway webinars allow financial inclusion practitioners like you to share lessons and attend online presentations and discussions delivered by the world's leading financial inclusion experts. Before we get started, I just wanted to share a couple of notes on logistics. First of all attendees will have their microphones muted automatically. So in order to ask questions during the webinar, please use the chat box on the right-hand side of the WebEx window. We invite you to submit your questions at any time during the webinar presentation, and we will address them in the Q&A session at the end. In order to make sure your question is seen by the moderator, make sure to select all participants from the drop-down menu when you send in your question. We have over 180 people registered for this webinar, and so we may not be able to get to everyone's questions, but we will share the panelists' contact information at the end so that you can also follow up with them if your question remains unanswered. And finally, the webinar recording and presentation will be available on the FinDev Gateway website after the webinar is finished, and we will also email the webinar recording to all participants. And with that, I will now hand it over to our moderator, Richenda.
Thank you very much, Abby, and good morning and good afternoon for wherever you are joining us from around the world. I'm delighted to be able to introduce our panelists this morning and to work with Macy Gan at the Global LPG Partnership, Sebastian Rodriguez, the CEO for Coppa Gas in Tanzania, and Alexander Sutiriu, who works at the consultative group to assist the poor. They will be our three presenters this morning. I'm very much looking forward to their remarks. This is just an overview of the timing of the webinar, which will go on for an hour, and each of the presenters will speak for about 10 or 11 minutes, and then we will have time for Q&A afterwards, so please do send in those questions. For those of you who are not so familiar with the cooking energy access sector, we are focusing today specifically on one of the clean fuels that is already used by about 3 billion people, almost 3 billion people around the world, and that experts, including the International Energy Agency, have seen as a viable fuel solution for about 1 billion of the almost 3 billion people who still do not have access to clean cooking, and that is liquefied petroleum gas, also known as propane, also known as cooking gas, which is a clean, portable, safe gas for cooking. It's a low carbon, it's mostly derived from fossil fuels, but it's a low carbon, plentiful, and friendly byproduct, which is actually much better for health and for the environment than the use of wood and charcoal. It is derived from fossil fuel predominantly, but green LPG, bio-LPG production is increasing. And one of the areas that we're looking at is how that will play in terms of moving to fully renewable fuels in the future. So cooking with LPG particularly can support healthier families and forests. Around the World Health Organization has modeled that there are up to, I think in the past they said about 4 million deaths per year prematurely because of air pollution coming from household emissions, largely derived from cooking smoke. I think they've revised their numbers slightly, but it's still a very large number of people who needlessly die prematurely because of the results of the emissions from cooking smoke, mostly from using firewood, charcoal, and dung for cooking, and kerosene also for lighting contributes to that problem as well. So LPG has lower particulates, which eliminates smoke inhalation, which means that it doesn't contribute to things like childhood pneumonia, which experts from the World Health Organization, such as Dr. Maria Neira, have said, in fact, the use of a clean fuel like LPG is the best vaccination against pneumonia for children under 5 years old because it avoids those deadly emissions. There's also less pressure on forests from using LPG because it either reduces or eliminates the need for gathering of wood fuel or for charcoal production, which in some countries, for example Tanzania, is putting tremendous pressure on the forests. LPG meets World Health Organization emissions reductions, therefore, for health, and it is shown not to exacerbate climate change because modeling has shown that there is slight net climate cooling impact from switching from wood and charcoal to LPG for cooking because of the reduction in the emissions. Why isn't LPG used more across developing countries for cooking? Well, it is increasing, and India, in fact, has been, through its Ujjwala program, implementing a massive LPG transition program over the last couple of years. But in those countries where it is still not progressing fast enough, there are a range of issues, including inadequate regulatory policies, market structures, enforcement to help actually grow and maintain market development. LPG, while it's plentiful around the world, isn't necessarily making it into the markets where it's most needed because supply chain constraints. Local companies, again, many of us working in development know this one, local companies don't necessarily have the financing that they need to really grow to be able to meet the potential market demand. And also, and the particular theme in this webinar is at the consumer level. On the supply side, those are the constraints. On the demand side, the constraints for lower income consumers are that there are upfront costs involved in the purchase of LPG for cooking, including the stove, the hose, the regulator, and generally speaking, a security deposit on the cylinder as well. And that's where it's challenging for lower income consumers to be able to manage the cash outlay up front, which is why innovative consumer financing solutions are needed, and you will be hearing about several of them this morning. So without further ado, I will hand over now to Macy Gan, who is going to talk about innovative microfinance for clean cooking. So over to you, Macy.
Thank you, Rachenda. Good morning and good afternoon, everyone. I'm Macy Gan, and I manage the LPG microfinance program at the Global LPG Partnership. So just a brief introduction to our organization. GLPGP was established in 2012 as a non-profit public-private partnership by the UN to focus on LPG for clean cooking. And our work spans three key areas. Firstly, working with governments on national plans, policies, and regulations to improve LPG supply and distribution. Secondly, to provide support to consumers in the form of education and financing solutions to switch to LPG, which of course is the focus of today's presentation. And finally, working with the research community to build the evidence base around LPG for health, climate, and the environment. So our microfinance program is called Bottled Gas for Better Life. We run this program in Cameroon and Kenya, and we offer short-term microloans to help lower-income families afford the upfront equipment that they need to switch to cooking with LPG. In addition to the loans, we also provide education on safe LPG use, and in all this, we work very closely with the local financial institutions and the LPG companies. The main goals of the program are to accelerate LPG adoption by poorer households who have been cooking with harmful fuels like charcoal and wood, and to prove that LPG household lending can be a commercially viable activity for these financial institutions to take on and expand on their own over time. So first I'll talk about the program in Cameroon. In Cameroon, we have grown the program to about 700 households since early 2017. We work with 2 Cameroonian microfinance institutions to offer loans of about $86 to lower income families. So these families repay the loan over 6 months at an interest rate of 1.25% per month. And with the loan, they buy a filled LPG cylinder and a double burner stove, as you see in the picture on the right here. In addition, in every community, we do some sensitization with a cooking demonstration, and we distribute leaflets on LPG use and benefits. In some rural areas, we will also have people going door to door to promote the program. So I'll now share some data from the current phase of the program, phase 2, and I just want to mention that we shared results from phase 1 in a previous webinar, so if you're interested in those, please send us an email. So now in phase 2, we have 509 households. They could be either existing or new customers of the MFIs, and all of them are screened in advance for credit risk. The average monthly income mostly ranges from about 60 cents to $1 per person per day. And Cameroon's national average income is about $4 per person per day, so these really are the lower income families. Their most common primary fuel was wood before starting the program. So as for loan repayments, not all the households have completed the 6-month cycle yet, so this data is preliminary for now. As of the end of January, we had 89% of the total loan capital repaid. So I think we are on track to achieving the 95% rate that we had after 6 months in phase 1. In fact, 68% of the households fully repaid the loan in under 6 months, and this is despite the civil disruption in Cameroon that began last year and unfortunately affected several communities that we were working in. So in addition to collecting repayment data, we are also surveying participants after they finish paying their loans. So here's a sample from one peri-urban community with about 100 households. After 6 months, 99% of the participants were still using LPG. However, 98% said that they were stacking, which means using other fuels in addition to LPG. And that other fuel is mostly charcoal, as you can see in the pie chart on the left. And it is used once or twice a week, possibly on the weekend when more cooking is done. The overall LPG consumption was about 15.7 kilograms per person per year, which is slightly lower than the 18 kilograms that we saw in phase 1 of the program. And lastly, 98% of the participants said that using LPG saved them time, and they used this extra time mostly for work and to rest. So now moving on to Kenya. In Kenya, we launched a similar program in August last year. The families take loans of $99 and they repay them over 6 months with an interest rate of 1.08% per month. However, unlike in Cameroon, Equity Bank, who is our financial partner in Kenya, were very comfortable with the idea of LPG household lending, and so they were able to fully fund the loan with just a partial guarantee from GLPGP. And these families used the loan to buy a filled 13 kg cylinder and a stove. And we also did community sensitization with a cooking demonstration as well as briefings to smaller community groups. So our participants in this pilot are from a rural village close to Nairobi. Their main cooking fuel was charcoal before the program. And we are now working with UC Berkeley to collect data similar to what I presented for Cameroon. So we expect to have those findings later in the year on the role of microloans in LPG adoption, effects of LPG on health, and the overall commercial viability of the program. So here are some initial observations from the Kenya pilot. Firstly, the loan offer by Equity Bank was not as well received as we expected, so we decided to also work with an informal savings group to offer the loans to their members. We found that the take-up was actually much higher through the savings group, and about half of our participants eventually came from this group. And this is probably because of the simpler approval process compared to the banks. There were also other factors affecting loan registrations, including income seasonality as well as prior experience with bank loans. So for instance, some people had experienced other banks increasing their interest rates after the loan was approved, and as a result, they were wary of signing up for the program. One interesting thing we learned, however, was that the group that took Equity Bank's loan has had a 100% repayment rate so far, and this is due not only to credit screening, but also to Equity Bank's mobile banking platform, which makes it very easy for people to make and to automate payments. So we've learned several things from the experience in Kenya and Cameroon so far. Firstly, the 6-month loan term is appropriate for LPG equipment, and people can in fact pay the loan and the interest on time. So with credit screening, this can be a commercially viable business for the microfinance institutions. We also learned that it's important not just to offer the loan, but also to teach people about LPG safety and both the health and economic benefits of using LPG, as well as to avoid delays in equipment delivery that will cause a loss of interest in the program. As seen in Kenya, as mentioned, we also learned that we can use digital finance tools in our future programs to improve repayment rates and data collection. And finally, we learned that beyond the current program, there is also demand for LPG for business use, for heating, as well as for LPG sold in a bundle with other energy services such as solar home systems. So all these are things that we would consider as we develop the program in the future. Now, before I go, here are some quotes directly from our participants. One woman says, "You don't feel anything when you cook using gas, but with firewood, smoke enters your eyes, and my children cough because of the smoke." Another woman says she will not regret using gas, and she says, "If I calculate the amount of firewood or charcoal that I would use, it would be more expensive than the gas I'm using." So with that, I've reached the end of the presentation. Thank you for listening, and I'm happy to take questions later. And now I'll hand over to the next presenter, Sebastian Rodriguez from KopaGas.
Hi everyone, my name is Sebastian Rodriguez. I'm the CEO of CoppaGas. Thanks everyone for joining today. I'm just going to speak briefly about what we do in Tanzania. So CoppaGas is a technology company, and we are focused primarily on LPG, developing software and hardware tools that basically help to transition families more quickly and faster and with a better experience. We are based currently in Dar es Salaam, in East Africa. It's a large city that is growing very, very fast. So it's projected to be the largest city in East Africa, and it's going to be a mega city in the next decade. So the challenge is how to provide services to all these families here, and it's about 2 million people that are willing and eager to switch to LPG. So the problem in Dar es Salaam is that currently almost 9 in 10 people are cooking with charcoal, and charcoal is very expensive. People cooking with charcoal today because basically you can pay a small amounts of charcoal for cook one day. So if you want to cook your meal today, you just go and buy a small amount. Charcoal has a big retail network, so it's very easy to and affordable to buy it. In average, a family in Dar es Salaam is spending around $30 per month on charcoal. The solution is really there. I mean, LPG is really the first candidate to remove that charcoal, and it's actually cheaper in this context in this city. So for the same amount of cooking, you would spend around $18 in LPG compared to the $30 you do in charcoal. But the upfront cost of having a stove, a cylinder, and a regulator is really the barrier for people to do that switch. So really our company is trying to come with solutions for those customers that are not able to finance that upfront investment. We also we are providing solutions to have it nearby, meaning cylinders and sales points closer to the customers, also warranting the quality of the product, and most importantly, the affordability of the gas. So we needed something. We developed a commercial and customer-grade IoT meter in 2015 that really helped on that affordability question. So the challenge was how we can sell small amounts of gas through a device that is connected to, that can be remotely connected and controlled, and that allows this pay-as-you-go model. So we come up with that piece of hardware, and basically we demonstrated a few years back that people can pay as little as 30 cents per day on their cooking needs. They're happy to do so, and they can use the mobile infrastructure, the mobile payments, and systems that are in place already in East Africa. So based on that hardware, we develop our business model. So we use primarily female agents that really find customers through women groups that exist, savings groups in the city, also through homeowners. We do verifications and validations of who these people are, if they have some credit history, or they are users or not of gas. After that, our team makes sure there is a safe installation, there is a proper training, and from that point onwards, basically the customers can start just cooking, paying for what they use using one payments, and in turn, the company also is in charge of switching the empty canisters when the gas is finished. So the meters allow us to monitor the gas level, and we have a customer service center where basically we can answer technical questions, payments, or even just basic training. So to do that is not easy and involves a lot of operations. Basically, in the back of our business, we are doing a very complex logistic operation. In Tanzania, we are not alone. We partner with a company called Oryx. They are a multinational oil and gas company. They basically are in charge of importing the gas, store it at the Dar es Salaam port, and they have a facility where basically we bring our cylinders and refill them in their location. But KopaGas is really in charge of the hardest bit of the distribution, which is basically the downstream and the last mile. This means that we need to coordinate movements of cylinders from the Oryx facilities to warehouses, and then to vehicles and small sell points. And with the pay-as-you-go model, we also are responsible of tracking the stoves, the meters, and financing the customers. So for all that, an essential part is really software. So software is a key thing of our recent focus. In the last 2 years, really our main investment plan has been improve our technology capabilities. Currently, we serve around 20,000 customers in pay-as-you-go and traditional models. So we have tools that allow us to track the customers and find them, and really create a database of consumption and usage around the city. So today we cover around 600 retail points across the city, and this is an area that is growing quite fast. To quickly share with you a couple of our learnings in this journey in the last 4 years. People really want to switch to LPG if you provide them some savings. I mean, that's a no-brainer. People really want to save money, and currently they are locked in with charcoal, which is getting more expensive in the case of Dar es Salaam. Charcoal is very difficult to use, and that's why no one really wants to cook all the time with charcoal. What we have provided is a new pay-as-you-go model that is efficient and easy to use. And really, the customers still don't see a lot of the benefits in terms of cleanliness and smoke but there is a lot of research about that indirect impacts on the health of the people. So a couple of data points from around 200 households. This is from a third-party survey made by Acumen, where basically almost half of our customers really are below $3.1 a day of the poverty line. They mostly report savings because that's how we designed the business model, to be cheaper than charcoal. And a third of them are new to LPG. So we have still people that we are solving a second problem, which is the refilling cost of a cylinder. So even though people could have a stove and a cylinder, they still have problems to refill it, the full amount. Then, of course, a big part of the cooking moves to gas, but still people are using some charcoal for some foods. And almost all our customers are female. And this is possible basically, again, thanks to the GSM technology in Tanzania, where a lot of people are used to pay and they have mobile wallets. So the benefits are really customers with more value, is a home delivery, it's a pay-as-you-go service, a user experience. And then for marketers, it's a direct relationship with those customers. Savings, because then basically you don't need so many intermediaries, and you have control on the cylinders. And the back of this picture, you can see a standard installation where now the stoves are at the right height, they are safe. We provide some fire blankets for extra safety. So the customers really get high value for what they're paying. So we really are into changing the quality of life of people. We are focused on what people really want, is that is efficient, that is affordable, and that gives them flexibility on the cooking fuels they want to choose. So that's really the challenge. And for anyone working on this space, those are the points that really any company needs to focus on address. Just keep providing more value to customers. And with that, I think I will end for now. And I just want to thank our customers, partners, and supporters. And thank you so much. So for me, that's all. Let me just move over the next presenter, Alexander, who is going to introduce the next part of the conversation.
Thank you, Sebastian. Give me just a second here to share my screen. There we are. So thank you also to the Global LPG Partnership for the invitation to participate in this webinar, and thank you to Rotunda, Macy, and Sebastian for sharing your knowledge about these innovations. And of course, thanks to everybody who's dialing in, listening, watching from home or wherever you are. My name is Alexander Sotiriou, and my work here at CGAP is focused on a similar set of innovations at the nexus of financial inclusion and other sectors in the real economy. We unfortunately haven't done much in the clean cooking arena, or at least we haven't yet, but I'm excited to see the direction that this work is going in, and so perhaps CGAP should be doing more here. But in the meantime, I wanted to, or I thought it might be interesting to share some insights that we've gained through our work in the pay-as-you-go solar home system business. I think there are some parallels between those business models and those financial products that are used to deliver solar electricity to households and those that can be used to deliver LPG. So specifically, I want to touch on two things. Pay-as-you-go is an innovation in and of itself, and also different means of financing goods or services for low-income households. So starting with the first topic, just a very quick overview of a PayGo solar home system product for those of you who are less familiar. As you can see from this slide, it's a very similar model to the one Sebastian described. And what it does is enable the customer to spread the expense of a larger purchase over time. Of course, one very important difference is that LPG is a service that requires more frequent refills of fuel whereas solar home system is more of a one-off purchase. But in both cases, the key innovation is a flexible payment option that is available to customers. So this slide gives a bit more detail of what that flexible payment option means to a low-income customer. If you look at the two horizontal green bars at the bottom of this slide, those are meant to represent examples of how different customers can approach their payments differently. Each green dot represents a payment, and the highlighted bar under the green dots shows the lighting that the customer receives from each payment. So in the top case, you see a customer we've labeled as an adapter who starts off slow, but then catches up to pay off the loan on time. In the bottom case, the customer we've labeled Stretch Flex pays in lump sums when possible, but goes without electricity from time to time. The importance of this flexibility in a low-income context should really not be underestimated. It's truly a revolutionary innovation. And this is an innovation that we believe has massive implications for customers, the companies that serve them, and even policymakers and regulators. So focusing just on the customer for a moment, consider the differences between this payment plan and that of a traditional loan. Any loan, we know, allows you to pay for something in smaller bits over time instead of a big lump sum all at once. That's the very definition of a loan. But if you miss a payment on a traditional loan, you accumulate arrears. And for a low-income person, those arrears can pile up into a mountain of debt that they could never escape. In addition to arrears on the principal of the loan, interest continues to accrue and maybe even penalty interest. But in this pay-as-you-go scheme that I've just described, there is no arrears. Customers just pay as they use the product. So just sticking with the customer perspective for another slide, here is a summary of some of the research CGAP conducted across 4 different countries with 4 different providers, where we interviewed 138 different customers. These were deep dive qualitative and semi-structured interviews, and we intentionally focused on lower income customers because we wanted to understand their perspectives. These are often customers who would not be welcome at a bank and may not even meet the criteria of many microfinance institutions. And the bottom line coming out of our research is that these low-income customers genuinely valued their relationship with PayGo companies, and that was largely because these companies were among the first to show them trust and respect. So I've talked a little bit now about what PayGo means for customers, but what is it about these companies and their products that allow them to serve that new set of customers? The key, again, is the remote lockout technology. The remote lockout creates a strong incentive to repay. It also makes it easier to repossess an asset if a customer defaults. So all of this combines to lower the risk or lower the cost of default for lenders, which in turn makes it easier for them to reach more customers. And without that lockout technology, PayGo customers, many of them would probably be too risky to serve at all because many don't have credit histories or regular incomes. So I hope it's clear by now why CGAP has been active in the PayGo solar sector. We believe that this is a business model innovation, or the business model innovations at the core of PayGo Solar could have a significant impact on advancing financial inclusion. We believe that these same innovations, remote lockout, remote monitoring, micropayments, digital payments, linking the consumption with the payments, all of these innovations can be used to finance a wide range of products and services for low-income households. We know, for example, that Coppa, one of the leaders in the space, has provided follow-on loans to its customers for everything from phones to bicycles, and yes, even cook stoves. So CGAP worked with another company, for example, called Phoenix, to develop an education financing loan for its customers. So I want to pause here for a moment. I know that I've described a lot of reasons to be excited about PayGo, and we do think that it's an exciting innovation, but we have our concerns too. These concerns relate mainly to the long-term sustainability and scalability of the business model and to the customer protection standards, which are not yet fully defined. So I won't go into too much on these concerns here, just don't have the time. But if you're interested in learning more about these nuances, please check out our work on cgap.org. So with the time remaining, I'd like to switch gears a little bit and talk about some bigger picture issues of what it means to provide financing that is directly linked to a good or service in another sector. So an ordinary loan, say a credit card or a personal loan, is a very different type of loan from one that is directly linked to another product. Say a car loan or a home mortgage or a solar home system loan or financed LPG. The key difference here is that there needs to be some coordination across different value chains. So you could put any number of other value chains at the bottom here. We know from Sebastian's slide that the LPG value chain looks different. But the main point that I'm trying to make with this slide is it's saying you're dealing with two very different value chains, and each one requires a mastery of different skills. And providing to an end customer something that is effectively bundled across these two value chains is a very challenging and complex endeavor. This is especially true for PayGo products because the repayment of the loan is so tightly linked with the usage of the physical product. And that raises the question, what is the best way to deliver this set of bundled solutions to a customer? So on this slide, we show a couple different ways of bundling it. On the far left, you have the category that I think probably represents PayGo solar home system companies. These companies start with an expertise in a particular product, say a solar home system, or in the case of KopaGas, LPG services. And then they integrate financing into that service to create a one-stop bundled shop for customers to receive their product. So I've already talked a lot about these companies. I won't say too much about them here. I'll also skip over that middle option in the interest of time. But on the far right, you have a joint venture between a company that focuses on financial products, and B, a company that focuses on a different type of product. So you could think of getting a loan from a bank to finance your car, or another example would be, I think, the types of microfinance partnerships that the Global LPG Partnership is working on. So I'd like to share a little bit about what we've observed of these types of partnerships with formal financial institutions. When we first learned about PayGo solar products several years ago, we had a theory that the clearest way for these products to scale and to reach more customers would be to partner with more traditional financial institutions. After all, MFIs and banks have several strengths that startup PayGo companies do not have. They already have existing bases of customers who may be interested in solar products, and they also have an expertise in the activities I listed in the earlier slide on the financial value chain, everything from managing the liability side of their balance sheet to managing credit risk. However, when we tried to get traditional financial institutions to provide PayGo products to partner with PayGo companies, we encountered a number of obstacles. So first off, traditional financial institutions have established methods of underwriting loans, and they do not like to deviate from those methods. Traditional microfinance underwriting methods are most typically used for financing working capital and sometimes longer-term assets, but usually not for anyone other than micro-entrepreneurs. They like to stay clear of consumer loans. And for all of those reasons, the customer base is typically in more densely populated urban and peri-urban areas. So a related point is that most traditional financial institutions are not very technologically savvy, or at least not as savvy as PayGo companies or other fintech companies. They have difficulty using technology to adapt their underwriting methods or to reach new customer segments. And lastly, traditional financial institutions do not like to offer flexible repayment methods. This issue alone can make it very difficult for them to extend their financial inclusion umbrella beyond their existing customers, and it makes it impossible for them to provide PayGo products. So our experience with working with traditional financial institutions and adapting innovative practices like PayGo has been challenging, to say the least. So that said, I absolutely think it's worth trying. We should keep trying to forge these types of partnerships. We're dealing with very difficult problems and can't take a one-size-fits-all approach. And there are many good examples of microfinance institutions providing non-traditional loans for their products and services in a way that improves the lives of customers. So here we have a slide describing a water and sanitation loan pioneered by water.org, which I think looks very similar to what the Global LPG Partnership is working on. We also know that MFIs in India and Bangladesh have been more successful at providing non-traditional loans than their African MFI counterparts. So there's probably some regional variation, and that may be due to underlying factors like population density, etc. So that's, I think, about all I have time for today. I hope these experiences and observations that I've shared have been useful to you, and I look forward to the discussion. So with that, I am going to stop sharing my screen here and turn it back over to Richenda.
Thank you very much, Alexander, and thank you also to Macy and Sebastian for your very insightful presentations. We do have a number of questions that have been provided to us. So in the time remaining, what I will do is I'll bundle them into a quick set of questions for each of the panelists. So I'll start with you, Macy. There's several questions that have come in to you. So and for those who provided the questions, forgive me for summarizing what it was that you were asking. So first of all, when entering into a relationship with a microfinance institution, does Global LPG Partnership offer a fund to back up defaults in the repayment rate? And is there any resistance from microfinance institutions to enter into these ventures? Also, do the stores have warranties? And how is post-sale service from retailers guaranteed? And then thirdly, what percentage of potential customers are denied by the microfinance institution, and who controls the loan approval, and how long does that process take? So if you wouldn't mind commenting on those questions to begin with, I'll pass it over to you, and then if you can pass back to me once you've spoken. Thank you.
Thank you, Richenda. Okay, so there were several questions there, and I'm going to try and address each of them in turn, but if I miss any of them, Richenda, please do let me know. So the first one was, is there a fund to back up defaults? The answer is yes. So Global LPG Partnership, when we first started the program in the very first pilot that we did in Cameroon, just because Cameroon was new, well, the microfinance institutions there rather were new to LPG lending. They were understandably unwilling to risk their capital for a pilot program. And so in that stage, the loan was funded by the Global LPG Partnership. However, we have found since then that with our work in Kenya and Cameroon, the microfinance institutions have different levels of comfort with the idea of LPG household lending. And so in Kenya, we were able to work out an agreement, as I mentioned, where the microfinance institution provides the loan capital, and the Global LPG Partnership provides a partial guarantee on the defaults. So the answer is yes. And ideally, as I mentioned in my presentation, the end goal of the project is to gradually build the comfort level of these microfinance institutions with the concept of lending to consumers for LPG, so that eventually they will take this on as their own program as part of their regular business. Really. So the idea is, at the end of the day, that they would not need such a fund to back up the default, and they would be able to run the program as part of their business as usual. But at this pilot stage, we are doing that with the institutions that we work with. So the second question about resistance from MFIs, I've already kind of covered that in what I just said, which is that yes, especially when LPG is a new asset class for these MFIs, they are a little bit hesitant to put up their own capital in the first instance. But I think that as we have shown positive repayment rates, gradually the microfinance institutions will become more comfortable with putting up their own capital. As for post-sale service, so the model that we work with in both Cameroon and Kenya is that we work not only with the microfinance institutions but also with the LPG marketers. So the marketers are the ones that really deal with the equipment side of things. So they will provide the LPG cylinder and the stove. So in Cameroon, we work with Tradex and Global Gas, which are well-established LPG marketers in those markets. And in Kenya, we work with the National Oil Corporation of Kenya. And so these partners of ours are responsible for, dealing with the equipment and the LPG side of the customer relationship. The next question, I believe, was about the percentage of potential customers that were denied. So at the moment, I don't have the number in front of me. However, I will talk about a couple of the reasons that customers we know have been denied. So it depends on, so first of all, as I mentioned, there was credit screening that was done in all stages of our program, except for the very first pilot stage in Cameroon back in 2017, where we were just, trying to pilot the program. So those customers were self-selected. But in all subsequent phases, we did credit screening, and of course, and also the credit screening is led by the microfinance institutions, and it is based on their own established rules for who to lend to and who not to lend to. So these microfinance institutions will lead the credit screening process, and if a customer does not meet their requirements, they will either impose an additional deposit, or they would deny the customer. Another reason that a customer might be denied was purely because of the main goal of our program, which is to create new LPG users. And in Cameroon, the experience we had was, especially in a lot of the urban areas where we offered the loans, a lot of the potential customers that came to us were actually already LPG users, but they want to either change their equipment because their equipment was broken, or they wanted to change their LPG supplier. And so we decided to put a cap on such consumers who were already LPG users, just so as not to deviate from the original program goal, which is to create new LPG users and transition people from cooking with charcoal and wood to LPG. So this was another reason that a potential customer might be denied if they were an existing LPG user, and in that community we had already exceeded our cap for existing users. So I think I got all the questions. Richenda, let me know if I missed anything.
No, that's great. Thanks very much, Macy. Moving on to Sebastian now. Several questions for you. First of all, is the customer center connected to the women's group that you work with, and do you train the women in the women's group on post-sale service? Second question is, what is the cost of the LPG meter, and what time does it take for you for the return on investment for the cost of the meter? And then there was a third question which actually came to Alex, but I think it's probably more targeted at you, which is somebody was asking about at what point a PayGo loan is in default if there's no fixed maturity. So perhaps you could repeat what PayGo is, given that it isn't a loan as such, but also just mention what contract length do customers have to enter into in order to be able to assure the viability from the company standpoint? Thank you.
Yeah, sure. Thank you so much. So in the first question, initially, yes, we started with these women groups basically doing the post-service, post-sales supervision. But as we grew and have more customers, we really needed to segment the task. So the women's groups and the SACO, the self-savings associations, are very good places for finding customers and have referrals. But the technical questions, the installations, the support is more a technical team that is on our payroll. So we have technicians, and that's a key part of our service, because still is gas, so we need to have certain standards and comply with regulation. So we maintain certain connection, but not for all the post-service part. So the second question is very interesting. So we, to clarify, we are a company that designs, manufactures, and basically imports these meters into Tanzania. So we have an office in China as well, handling the manufacturing. So the price at which we could sell the meters to a third party is a function of many things, but it's not the point here. But the return on investment we do on the meter really, in our mind, is a function of a couple of things. So the total package that we are financing, basically, meaning the stove, the cylinder, the gas inside that cylinder, and small accessories on the meter, roughly speaking, is something between $120 to $140. The difference is because the type of stove. Some people prefer different types, and that's really a preference. So we carry a couple of variations on the stoves from feedback from users. But it's very similar to the amount that Alexander was showing about the loan amount that WaterAid is given, and also similar to a medium-sized solar home system. So we really think that's the issue. To make it cheaper than that, you start going into compromising functionality and security and things like that. But to really get the return on investment, the other side of the question is how customers are using the device to consume gas. So, for example, some of the mistakes we did at the beginning was very interested. People that look wealthy and young professionals even, they have available capital, but they are not cooking at home. They are not really the best customers for the company. So it really is about a function of cost and a function of utilization. So all that is about, at the end, is logistics and how we serve these customers. So it's a difficult question to answer, but I'm happy to take that individually, and also depends on the market and so on. So you can contact me for more information. Regarding the default, so in a way, currently our current business model is that customers do own at the end the stove, but the meter and the cylinders are our property. So we are in charge of any repair that needs to be done into the meter. It's a metrology instrument, so we need to keep that in our balance sheet. So really what we have is about enforcing some minimum consumption. And if people are really not using the asset, we repossess that asset. So it's about that what I call default in our system. So I hope I answered those questions.
Great, thank you very much, Sebastian. And just to those of you who have posted questions that we may not be able to get through in the session, we will be providing everybody's email addresses afterwards, so you can follow up personally with the presenters. Moving on to Alexander, some questions came in specifically about the PayGo model. For example, how do you encourage providers to take the initial risk if customers are not traditional clients? And I think that can be both for microfinance and for PayGo models. And also, under the PayGo model, is the initial infrastructure investment also provided through the PayGo model? If you could just comment on those two. Thank you.
Sure, I'll do my best. I'm not sure I quite understand what the question is about the initial infrastructural investment. Does that mean that sort of the capex related to the solar home system? If that's it, then the answer is yes. The idea is to create a bundled product, and the customer only sees one payment at the end of the day, which finances the whole thing. And it's worth noting too that there are many permutations of PayGo contracts out there. It would take too long to cover all of them, and different customers or different organizations structure those things differently. As for how do you encourage the providers to take the initial risk, I'm not sure if that question really applies so much to the PayGo companies themselves, because they don't really need encouraging. They're already doing it. That's their core business. As for working with, say, a microfinance institution, as I alluded to, it's really been a challenge for us to get them to think about this. Yes, you could provide partial risk guarantees and hope that by giving free money to banks, they will continue doing that business in the long run after you remove the free money. But there's been kind of a long history that with mixed results of taking that type of approach. I think you really need to convince them that it's in their best interest with data of the available market size. But even when you have that, and we do, the processes and procedures of a traditional bank are very challenging to integrate with any type of innovation. So we've talked with microfinance institutions, and they say things like, well, we would have to go through our loan officers and do this underwriting and have, basically they want to take their own approach and put it on PayGo, and that hasn't been very effective. We're starting to see some glimmers of others starting to pilot and do things in an interesting way, and some microfinance institutions actually creating separate divisions that focus on this new class of customers. So that looks like a promising way, but getting traditional customer banks to do it, I think, is extremely challenging. I did want to circle back to the question about how do you define default in a PayGo situation, because it is a very difficult and fascinating question, because you can't use the same type of metrics that you would to define default or portfolio at risk. Par 30 in microfinance is this key metric that everyone has gravitated towards. That just does not work in this context. So, Sebastian mentioned utilization rate, which has become kind of a common way to do it, which is basically how many days out of 100 is a customer using a product, and then the company can decide that, well, my product is profitable if a customer is paying 70% of the time, and as long as they're doing that, it makes sense for me to do this business. But there's a lot of data analytics that go into figuring that out, and that's been one of the challenges for other non-fintech, non-technological financial institutions. So I think that was it. Did I miss anything?
No, that's great. Thank you very much, Alexander. And just a comment from the LPG sector, one of the key metrics that's used across the LPG sector for cooking is actually around the kilograms per capita per year of LPG, because you can map consumption as to whether or not a family is using it full-time, or they are stacking and in terms of utilizing other fuels. So thank you very much to every one of our participants. And just as a reminder, that these are our email addresses, and each panelist has kindly agreed to follow up with those whose questions perhaps weren't answered, or if you've had other questions during the course of the webinar, then please do contact each of us to learn more about our work and to hear more about the various approaches. It's a very exciting time. I think you probably gathered from this webinar that there is likely no one-size-fits-all financing approach. Different countries, different contexts, make either PayGo more easy or make microfinance easier, relatively speaking. So this is the beginning of a very exciting new era for really looking at how we can be driving lower income households to uptake the LPG that many of them actually do want across much of the developing world. So with that, I will say thank you again to our panelists and close out as the moderator and hand back to our host. Thank you.
Thank you very much, Richenda, and all of the panelists for sharing your insights on this fascinating topic. Now, we'd like to hear from all of the webinar participants to get your feedback. If you can please take a brief moment to respond to the poll questions, which should appear on the right-hand side in your WebEx window now. And just before we go, I wanted to mention what's next. As I mentioned in the beginning, we will share the recording from this webinar and the presentations. They will be available on the FinDev Gateway website by tomorrow, probably, or within the next few days. And we will send a follow-up email with the recording to all of those who have registered for the webinar. And please feel free to share this with your network. And finally, we would like to invite you to our next Gateway webinar. The link to the webinar page will appear in the chat box as I'm speaking. On March 12th, we will host a webinar called Change Management, Business Opportunity and Customer Centricity. This webinar will walk you through a series of steps that management teams can take to prepare, equip, and support employees as the organization shifts to a more customer-centric model. Once again, a big thank you to the presenters and to all of you who joined the webinar for your questions and engagement on the topic. Thank you.